You've probably heard that the S&P 500 is making new all-time highs. What about other pockets of the market? Are they doing as well? Let's take a look. Hi, my name is Eric Blattner with Divvy Wealth Management, and thanks for watching. Before we spend a few minutes talking about today's topic, I just want to remind folks that if you like following along with our thoughts, the best way to do that is to head over to our website. That's divvywealth.com, DIVVI wealth.com, where you can sign up for our blog. Typically, about once a week, we'll send an email out with thoughts around markets, investing, financial planning, things along those lines. Or you can head over to YouTube and search at Divvy Wealth Management and subscribe to our channel there. So with that being said, let's turn our attention to the S&P 500 making new all-time highs again. We've been talking about this for the last few weeks, and ultimately, I think it begs the question for a lot of investors with the S&P 500 making these all-time highs, is it time to sell? Is it time to reevaluate what we're doing with our investment strategies? And I think it's a very fair question. So before we get into a lot of the details, I just want to remind folks that this is for educational purposes only. It's not financial advice, and your situation is likely different from many other folks that we talk to. So with that all said, we've really outlined in our blog post 4 reasons that S&P 500 making new all-time highs in and of itself may not be a quote-unquote sell signal. We've talked about stocks being long-term investments. Here's a link or a button that can take you to a video discussing that topic. Last week, we talked about the difference between price and value and how those two, you can't always infer value based on price alone. And this week, we're going to talk about another reason that you likely are invested in other areas outside of the S&P 500. So it might be helpful to look beyond that particular index. And then the 4th reason is that selling, buying, making a lot of decisions really introduces the opportunity to make more and more emotional decisions. That's typically not good. So we'll talk about that next week. But for today, we're going to focus on other markets, other areas of the world in which we likely have investment exposure. So I'm going to show a chart here in a minute, but really when we think about the S&P 500, it's just a label. It's an index that is defined by a few very simple characteristics. So what is the S&P 500? It's an index made up of big companies that are primarily located in the United States, and they're publicly traded. That's pretty much it. And it's roughly 500 of these biggest U.S. publicly owned businesses. So to put that into perspective, when I do a quick search for the number of stocks that have shares traded on major U.S. exchanges, I get a list of about 5,400 different companies. And I applied a few filters, so there's probably more that I'm missing there. So when you think about it, that 500 stocks is really a drop in the bucket when it comes to just the opportunities that we have to invest just even in the United States. That doesn't even include other asset classes like bonds or foreign stocks, things of that nature. So when we hear the S&P 500 making new all-time highs, that's really one representation, one index of our investable universe, so to speak. And it's certainly done very well. It's up another roughly 4 or 5% so far this year. And as we think about that, going back to that question of, is it a sell signal? One of the reasons that we think it might not be is that you likely don't have all of your investable assets in a fund, an index fund, that's designed to track the S&P 500. So there could be other pockets of the market, other pockets of your investment portfolio that have not participated nearly as much. So with that, here is a chart that outlines a bunch of other groups of investments. And these are all different indexes. If you want the full list of which indexes we used to represent these different groups, head on over to our blog. And then in the disclosure, we list all the different indexes that are represented in this chart. And I've basically bucketed them by color. So all the green bars are going to represent groups of U.S. stocks with different types of characteristics. The orange bars are going to represent groups of foreign stocks, companies outside the U.S. The brown bars are going to include bonds or fixed income. And then finally, the black bars A few liquid alternative options are represented in the chart as well. So it doesn't include things like private markets, private equity, venture capital, hedge funds, things of that nature. But it still gives you a decent representation. And basically what we look at, again, through that lens of S&P 500 making all-time highs, how have these other groups of investments performed relative to their recent peaks? And so we basically look back a couple of years. And you may recall 2022 being a very challenging environment for investors. Stocks were down, bonds were down, real estate prices were down. And so from those peaks, have those groups recovered all those losses and made new all-time highs? And clearly the answer is no. So the first thing that should jump out to you looking at this chart, the top of the list is dominated by green bars, U.S. stocks. And if you look closer, it's going to be dominated by groups of stocks that are generally defined by size. These are really big, mega cap stocks. Think of like the biggest companies in the U.S., Microsoft, Apple, Facebook or Meta, Google / Alphabet, NVIDIA. These companies are going to be represented in those top few bars. And growth-oriented investments have really performed particularly well. So if you look down further at some of those green bars, small cap stocks have generally trailed by a pretty good margin. Small cap, these are just companies smaller in size. So there's a lot of different ways to kind of define that. But when we think about how those groups of stocks have compared to their bigger alternatives, they've generally lagged. Next, look at some of the orange bars. These are foreign stocks. And start by looking at the bottom of the list. Emerging markets are still roughly 25% below their previous peak. So when I talk about emerging markets, those are generally going to include investments in countries like China, India, most of South America, Latin America, Eastern Europe, a lot of Asia are really going to be. Those countries are going to be included in emerging markets, and those stocks have generally not performed nearly as well as those big U.S. companies have. And you can look up some of the foreign markets that performed a little bit better, or the more developed markets like Western Europe, Japan, things of that nature, are going to be included in those developed foreign countries. And then we look at the brown bars. These are bonds, and I think a lot of people think of bonds as being kind of a slow and steady way to generate pretty decent returns, not great returns, but generally positive returns, and that has not been the case over the last couple of years. It's another reminder of how bonds perform in the face of rising interest rates. We all know that if we think back a couple of years ago, inflation started to really be a thing that we spent a lot of time talking about. Prices were rising, interest rates were rising, and there's kind of a inverse relationship. As interest rates rise, bond prices typically fall. And the higher quality bonds like U.S. Treasuries and the longer term bonds like 30-year Treasuries, they really have a lot of sensitivity to changes in interest rates. So if you look at the very bottom of the list, one of the worst performing groups over the last couple of years has been those long-term U.S. Treasury bonds. But generally speaking, bonds are still quite a ways away from their previous peaks. Again, a reminder of how those prices can behave when interest rates are rising. And we included some of the liquid alternatives as well. So things like commodities, REITs, that's an acronym for real estate investment trusts, also well below their highs. So with all that being said, I think we just wanted to remind folks that as the headlines continue to focus on the S&P 500 making these new all-time highs, unless you have 100% of your investable assets tied up in an index, and I shouldn't say tied up, invested in an index fund tracking the S&P 500, you likely have exposure to other markets. And we do this. Diversification is really more about managing risk than maximizing return, with the idea that if you do have diversified exposure to different parts of the market, there will almost always be certain things that you own that are currently not doing very well. That's just the nature of the beast. I won't go into too much detail about correlation and things like that, but diversification is basically about having different assets do well at different points in time to try to reduce some of the volatility in your portfolio and hopefully give you a little bit more certainty around how you're going to meet some of those long-term investment goals. At least that's kind of the way that I think about it in a nutshell. So to kind of summarize here, is the S&P 500 being at all-time highs in and of itself a sell signal? I think we've talked about a few reasons why it may not be the case. This is just the most recent example, or I guess an additional example of why it might not be the case. Diversification, exposure to other markets, owning other assets that have not performed nearly as well. So if anything, it may be an opportunity to revisit your portfolio and try to think about the intent. What were the targets that you initially had? How much did your asset allocation mix? How much did you intend to have in these big U.S. companies? How much did you intend to have in small cap stocks or foreign stocks or bonds, things of that nature? And look at where we are today compared to where what those targets are, what you intended to have invested in these different markets. And if anything, it might be an opportunity to rebalance or assess some of the risks that you have in your portfolio and make sure that you're still comfortable with how everything looks at the current point in time. So hopefully that helps. If you have any questions, don't hesitate. Reach out to us. We'd love to help. And as always, if you would like to follow along, please go back over to divvywealth.com, D-I-V-V-I wealth.com, and sign up for our blog. Or you can head over to YouTube and search at Divvy Wealth Management. Subscribe to our channel there. And again, thanks for watching. We appreciate your time. Hope you have a great day.